Okay, peeps, welcome back. So today we're going to be going over the macro markets overview for May of 2024. So with that being said, let's get it. All right, you guys know how we do this content. We usually go over multiple different subsets of macro indicators, indices, and whatnot. So with that being said, let's get into the content. We're going to look at the S&P or the SPX here in a minute, but first I want to go over the fear and greed and the CME watch tool. So you guys can see that the current fear and greed indicator reads as a neutral. So markets are neither bullish nor bearish. You can kind of pretty much see that in the way that the price is moving here. So you see we have this downtick, kind of a sell-off into the EMAs and then a pump, and then we're just going sideways. So this is only a slightly higher high. Based on the price action, I would say that the indicator here on this particular site for the fear and greed index is actually accurate. As you guys can see, a month ago we were in fear and a year ago we were in greed. Keep in mind, in bull markets, there are dip buying opportunities. In bear markets, there are opportunities to sell into the suckers rallies, as they're called. So going over the CME watch tool, as you guys can see, the next FOMC meeting is in just basically 10 days. So we're going to find out what the Fed's going to do then. Some people think they're going to want to hike because inflation's still kind of a little hot per se, but really, is it though? I mean, we're down from 9% to about 3.5%. In my opinion, the hardest part is going to be going from 3% to 2%. I could be wrong about this, but I would say the likelihood that the Fed is going to hike rates at this point is pretty much zero. I don't think they're going to hike rates. I think they would personally rather hold rates for a year straight and not do anything because, again, the government has to pay interest on its debt, and the higher the Fed raises rates, the more expensive it gets to pay that interest. So at some point it becomes unaffordable for the government, for the Treasury Department to do so. So let's take a look at the expectations of what the market expects. So you can see the markets are pretty much in line with my personal theory of what I think is going to happen on this next FOMC meeting, which is basically just another pause. Again, it would not be the first time in the Federal Reserve's history that they've spent 6 to 12 months basically being at a pause at all-time highs for the Fed funds rate. It's not the first time, so it doesn't really come as a shock. So next month, same thing. No rate hike, but no rate cut. Pretty much just a pause. So this is interesting. Before the first rate cut was actually, according to the markets, was set to be in November. But from what we're seeing right now, they've actually flipped the switch and they've decided to go back to September as a slightly higher probability of a rate cut than another rate pause. So perhaps we see the first cut in September. Following that, you guys can see that after the first rate cut, there is another pause. And then we go to December. December still paused. And then we don't get another cut until January 2025, as you guys can see here. And if I go all the way up to September, let's say next year, you guys can see that there's not really that many rate cuts going on here. I don't think the Fed's going to keep rates that high for that long, in my opinion. I think like they said, they're data dependent. It depends on what it shows. If, let's say, over the course of the next 3 months, inflation drops magically to 2%, which is a possibility, they might just go ahead and start cutting rates immediately, like 50, 75 basis points a month until they get to zero. Kind of similar to the pandemic back in 2020, but we won't know until we know. Okay, that's kind of just how it works. So SPX, again, this is the measure for the S&P 500. This is the actual S&P 500. The SPY is not the S&P 500. That is an ETF based on the S&P 500. So you guys can see we have this MACD death cross back here. Every single time we've had one of these, I pointed this out to you guys on X. We had one here, a drop in the markets. Had one back here. It took a little while, but we did eventually get a drop in the markets. And if I actually pull this up, you guys can see that there was also another MACD death cross here and did also get another drop in the markets. Now, in one of those situations, the MACD EMAs were below the break-even level, and the rest of them, they were above it. However, I do want to point out that we are still holding the EMAs. So we got to break at this trend line, still holding the EMAs. The only kind of bearish thing here is that we fell out of this channel and we're now retesting it, and it looks like maybe getting some kind of rejection. Although I think that's not likely because this candle, although it's a red candle, is a hammer candle. That is a bullish candle, okay? Usually when we get one of those, it means upside. So we got one here. You guys can see it did go up. It wasn't immediately up, but it went up very, very shortly after that for a long period of time. If I go back in history even more, you can see we got one here. Price went up. We actually got two here. I'll just simply call this one a hammer candle, and this is a tweezer bottom, and then boom, shot straight up. So you guys can kind of see why I would be bullish on this red hammer candle. So if I were to actually redraw these trend lines like to fit perfectly, let's say this would be a rising wedge. That's a bearish pattern. This would be a upward channel, which is still a bearish pattern, and this would be a rising broadening wedge, all of which is still a bearish pattern. So no matter how you want to look at this setup here, this is technically speaking bearish, but the price is above the EMAs. So where could this thing bounce? It's either going to likely go back up from where it is based on the hammer candle and retest kind of this 54.20 level before maybe getting a rejection or going back into the channel. It depends. If we get some kind of drop and maybe down to 5,080, I would say is likely. That could be a good bounce point because, again, we have a wick here. Usually buyers look to kind of base a support level based on structure, i.e. lots of trading volume, resistance turned into support, or some kind of like major wick lows here. As you can see, there's one here. So probably a lot of buyers are going to step in right around 5,000 to 5,080 to scoop this up. If not, then it comes down to like this red EMA at 4,800 again, which is the previous all-time high. We don't actually have any candle confirmations that technically really closed. Well, I suppose this green one and this red one did close above these three previous tops here. But again, this is not like a big move, like a big spike up and then a retest. It's only like a little kind of pathetic spike up and then a retest. So can't really call that a flip zone and a retest, but we'll have to see how the week plays out. So that's the S&P 500, NASDAQ. As you guys can see here, it got a break of this, what looks to be like a bump and run pattern. And it did break out quite nicely. So we're currently sitting at all-time highs. This actually looks more like a flip zone. So if I were to draw a line straight across here, you guys can see what I'm talking about. So this is all resistance right here. And then we broke out of it. This little candle confirmed a break out of it. And then we had a following candle green and coming back to retest it. And we did close above that line. So there's a likelihood this could just simply bounce from where it is. Again, that's at 18,500. But of course, starting tomorrow, we'll find out what that's going to be. In terms of the channel here, so again, this can be measured any kind of way. So we can measure it like this. That's a rising wedge, like the S&P, that's bearish. Rising channel, bearish. Rising broadening wedge, bearish. Doesn't matter how you measure it. They're all bearish patterns. The question is, do we get back inside of this channel and continue to go up or get rejected off of it and then smash to the downside? That could happen. So if it goes down, likely it's either going to bounce from where it is right now, or likely it might go down to, I would say, probably somewhere around this wick. Again, I think that's likely where it's going to bounce, 17,300 to 17,700. If not, maybe it gets stopped right here above this zone at, I would say, about 16,900, 17,000, somewhere in there, because again, a lot of traders that look for bounce opportunities off of these bullish areas. So this is bullish, gets a long downside wick. That's very bullish buy zone. And this was the swing low. So the swing low would be another bullish zone to buy. And as you guys can see here, the move here was huge. It went from 17,000 to roughly about almost 19,000. So Russell 2000, this one looks a little more sketchy. I don't like the way this one looks personally, but we're going to go over it. So MACD histogram is turning a little bit less bearish. That's a good sign. But the indicators overall, they're not really doing much. I mean, again, this thing basically since December kind of more or less has just been ranging. If I were to pretty much draw some lines in here, I would say this thing really is just kind of sitting in a range currently. It's not really doing much of anything. So it needs to get out of this range to make a move one way or another. But I'm actually going to flip this to support now because this is currently support. So if it comes down, likely it's going to test somewhere in here in support. Again, that's roughly about 2000 to about 2031. That's a major level. If I pull this back, you guys can see that this was resistance forever during the bear market. So August 2022, January 2023, July 2023, every time the Russell 2000 got rejected off of this. Of course, the Fed has been raising and holding rates this entire time. Russell 2000 is comprised of smaller market cap companies, which again, when it's more expensive to borrow, which is what's going on right now with the Fed, it's harder for these smaller companies to make money if they're not able to borrow funds at cheaper rates. So that explains why the Russell's struggling. But as of right now, this is resistance, flip, support. So again, I suspect if we're going to bounce, it's going to be somewhere in this green box. One other thing I want to point out too is that we did get a break bearish out of this rising wedge pattern, as you guys can see here. Usually the target is the bottom of the wedge. Do I think it's going to go down to 1600? No, I don't. But I do just want to point that out. So again, we kind of have this, well, can't exactly measure it like that. I suppose maybe I could measure it like this. The problem with trading is sometimes you just get setups that, just change on a dime and you're just really not sure exactly how to go about this. So the thesis behind investing and trading technicals really is always trading. A lot of people, want to get on my case about that. Like, well, you said this, you said that. I'm like, well, dude, markets change 24/7, 365. Crypto is a prime example of that. It's never going to be the same. I don't know what to tell you. I mean, I'm not God. I don't make these markets. I don't control them. I just am showing you guys what's going on. So, we're looking potentially, I would say basically pretty much at a channel right now. Again, I think this is probably about the most accurate way I could measure it. This is a bullish hammer candle. Okay, the price could potentially just go straight up based on this. If it does drop, I would say likely we probably drop somewhere back into this zone. I should pull that down a little bit. So we do have a MACD death cross here. The histogram's still looking red. That's not good. We're coming off of, so we have increasing price, but the MACD and the RSI are going down. That's a bearish divergence. So that's also not good. But the other thing I wanted to point out here is that there's two potential support areas that we could be looking at. So somewhere around the bottom of these wicks and candles here. So I would say roughly about 37,900 down to 37,600, somewhere in there could be a bounce point. Because again, you have a lot of these wicks here, and traders are going to be looking at that thinking that they're going to buy the dip, or as low as 37,200. So let's go over stocks in the S&P 500 and NASDAQ 100 with the 50-day moving averages and 200. So S&P 50-day moving average, quite simple. We got a hammer candle, a very bullish hammer candle. Likely this thing is simply going to go higher. Again, this is more expensive than it is cheap, in my opinion. So for swing traders looking to get in at the absolute perfect time, well, usually when this is above, how do I want to say this? Usually when this is above 50, that's usually a good time for swing trades to be on, so to speak. And currently it is above 50. So, I mean, there's not really much else to say about that. NASDAQ, a little bit less certain. So this is below 50 for swing traders looking to get in. Ideally, they want to see it above 50. But again, this is more expensive than it is cheap. But we did just come off a major swing low, as you guys can see. So this thing could still be poised to go higher, in my opinion, before we see an actual sell-off. So I'm going to go down now to the 200-day one. So those of you guys that have followed the channel for a while, you know how this works. We're getting very, very close to the top of this sell zone. On the 200-day, that is usually a pretty major bearish indication. You guys can see when we got close to these sell zones on these 200 days, almost every single time we had some kind of drop-off, whether it was a big one or a small one. Well, that remains to be seen. As of right now, we're seeing it's actually getting pretty close to that red zone. So when it did get in there the last two times, there was a major sell-off. So for people looking to buy the dip on dividend paying stocks, ideally you want to see it get closer down to this green box, either on the 200-day or the 50-day, and we currently are not seeing that. But of course, you can buy dividend stocks whenever, cheap, expensive, doesn't matter, because you're going to get paid dividends, right? A lot of dividend investors don't care about this. They care about the passive income. So NASDAQ, pretty much same story, although it's not as close to the sell zone. But you can see similar story. Every time we got in the sell zone, this thing did have a major capitulation, maybe except this last time. And this most previous rundown that we had here, you guys can see the move is quite a bit smaller, but that's probably because the markets are convinced that the Fed's getting close to cutting rates. Okay, so inverted yield curve, nothing's changed there. Again, that's not going to change till the Fed cuts. This thing is likely not going to uninvert until the 2-year goes back down below the 10-year. Currently, the 2-year is at 4.87, 10-year is at 4.5. Now, if the 10-year is at 4.5 and the 2-year gets down to like 4.2, you have an uninversion of the yield curve. Likely, there is going to be a short-term, immediate pullback in the markets. How big it's going to be, I don't know. Whether it lasts a long time or not, I don't know. We'll just have to wait and see. But that would be a first major warning sign to potentially either, again, not financial advice, but stack some cash or get out of certain positions, depending on how the market reacts. Again, we'll have to be watching closely and see what happens there. So Fed funds rate, we already went over that. Still at all-time highs. They're still holding. They're not going to cut until they see inflation get as close to 2% as possible. I am pretty confident about that because, again, no currency, no country, right? So inflation, headline inflation is currently at 3.4. That's good, but not great. Again, if headline inflation was below 3% consistently, I would say there's a strong likelihood that we're going to see a cut. And also very similar thing with core inflation. And core inflation is actually more of a challenge to get down, as you guys can see, than the headline inflation. And I would say likely the Fed cares more about core inflation than they do headline inflation. So again, we need to see roughly about a half a point drop on each of these, or maybe even a 75 basis point drop on each of these to see that the Fed would be convinced to actually start cutting rates. Okay, unemployment rate. I'm not going to click on this one. We already talked about this one before. We do not want to see this thing tick up. This thing did have a MACD golden cross. That's a bit concerning. It usually takes a while for the unemployment rate to go up and play out. I would say probably about a year out. So likely, probably from the first cut, maybe we'll look a year out and see how things look. If they're going to start their first cut in September, maybe look for September of next year to potentially be somewhere either around the start of the increase of, you know what? Let's just take a look at it. So as you guys can see, we have the unemployment chart here. So the thing we're looking for, you can see this tick up, okay? So from October 7 to September 09, so this basically took 2 years for unemployment to top out, or the rise of unemployment to top out and then fall back down, but it took many, many more years for it to go down. Kind of similar thing here, although not so obvious. This was actually closer to 3 years, and then it took 4 years to bottom out. So again, I suspect this thing will not start significantly rising until the Fed cuts rates, but that's something we're keeping a lookout on. So now let's go ahead and talk about oil. You know what? Yeah, I'm actually gonna go with the micro oil because we already have the major levels set in here. Okay, so oil is looking pretty bearish. EMAs are curling down. MACD had a death cross. RSI had a death cross. Basically, we're looking at a potential bear formation here: high, low, lower high, and ideally a lower low, or at least it goes back down to this zone. This is a shooting star candle that's very bearish, so I suspect next week for oil is probably going to be bearish. The bounce zone is going to be somewhere between $72.30 to $74, and your resistance is roughly about 81 as of right now. So let's get into the metals here. We're going to go over to the monthly time frame. That's how we do it for the metals because, again, they're much slower moving. All right, so we have so there was a big breakout here out of this triangle pattern. That's not surprising. We pretty much pointed that out. But we do have a tweezer top here, and these are both shooting star candles. So likely gold is going to sell off next week. That's just my opinion. But that's a double bearish confirmation. So where could it go? It's probably either going to stop somewhere around 22.30 or maybe perhaps over the next coming months, maybe go all the way back down here to these resistance levels and test at 2,080 on gold. Gold is very expensive right now. I personally will not be buying any gold until I see the prices of gold come down, which is not going to happen until the Fed cuts rates. That I am confident about. So silver, moonshotting, we do actually have some silver. So there is a breakout going on here. There was also, it looks like a very, very long-term inverse head and shoulders pattern. So shoulder, head, shoulder. And if I were to measure this out, basically from the breakout point, it's looking like silver might actually go much higher. So based on this target, likely all the way up to 38, 39 bucks, somewhere in there. But this is a confirmation breakout candle above this resistance. So likely if it comes back and retests support, it's going to retest at around $29 because this was the previous peak, as you guys can see here. So again, silver is quite expensive right now. In my opinion, if we were going to buy it, we should have bought it a long time ago when it was cheaper, which we did, but we also sold for profit. So palladium, this is an interesting one. So it does look like it's about ready to bottom out and head higher. So this is quite curious. So we were actually looking for this particular zone to get into palladium. So we may actually go down to the coin shop and get some because this is exactly what we were looking for to get in. We didn't want to get in until it came back and retested these highs, and it is now doing so. So now, in my opinion, not financial advice, is the perfect time to pick up some palladium. Again, we're about to have a golden cross here and a golden cross on the RSI off of the oversold territory. Again, this is not financial advice. You guys can do what you want. So from the current price to the high here, as you guys can see, there's a massive upside, 275% move. The only thing I would say about palladium that concerns me a little bit is all of these kind of bearish wicks here. You can see this is also a shooting star candle, so this may actually not even be the bottom. Maybe it kind of bottoms out somewhere around 850-ish, but I mean, if that's the bottom and we bought now, we still wouldn't be that bad off, in my opinion. So platinum, doing a whole lot of nothing. Again, we're looking to get in somewhere at the very least at 840. The bottom here is at 690. I don't think it's going to go that low. Resistance 1177, 1320. We'd be pretty much hands off on this one. If we were going to buy it all, it would be like very little. We'd buy very small amounts over a longer period of time until it got down into this zone. That's just kind of how we would do it. Otherwise, we'd be strictly hands off. So copper looks very bullish. Again, this is an indicator of economic demand. So it doesn't look like the economy will be slowing down anytime soon. So again, we have another golden cross off of the kind of break-even level bull zone here, pretty much right as it was testing. So that's a good sign, expecting copper to definitely go higher at this point. So we have a higher high here and a wick high here, which indicates potential price discovery. Usually when you get a wick above the previous price action, that's indicative of further moves in that direction. The only thing that concerns me is a shooting star candle. Bears came in or profit takers came in and sold at these areas. So maybe a slight pullback into the EMAs before a rip. Again, that could be anywhere from around 4 to 410. I mean, copper is cheap, but we wouldn't buy it at this point because, again, we'd be waiting to get in somewhere in this green zone. If you're looking to trade this thing, this might be, again, not financial advice, but a good potential set of signals here to maybe get in for like a short-term profit or something, but that's up to you. So we cover Bitcoin in a separate video. We're not going to go over that in this video. Let's instead go over the DXY. So again, this is the dollar index. This is the strength of the dollar or the weakness thereof. So we're in this kind of coiling pattern. This is an ascending triangle, but because of the fact that the dollar's been at all-time highs for so long, I'm actually expecting a breakdown here, not a breakout. This usually would be a bullish pattern for higher lows into a flat top, but I don't think there's going to be a breakout again because we kind of have this double top here that's bearish. Also, we have basically basically a slight bearish divergence. So the price is going up, but the MACD and the RSI are going down. It's not very obvious, but you can see it. And we also have a high turned into a lower high here. Obviously, we need to get below the structure level right here at 101 to prove that this is indeed reversing into a bear trend. So as of right now, DXY still looks strong, but I suspect there is going to be some kind of sell-off soon. So going over the VIX, again, VIX not doing much of anything. It's at all-time lows. If you're looking for a golden buying opportunity in dividend-paying stocks or growth stocks at dirt cheap prices, meaning the market's dumped off like 20, 30, 40%, ideally you would want to get in somewhere around these levels, around when the VIX hits like a 40, 45, 50, somewhere in there, or even as high as an 80. that would be the best time to buy into the fear, in my opinion. And it does look like there's about to be a MACD golden cross. So maybe the VIX is about to turn up. We'll just have to wait and see on that one. So anyways, this is the macro markets for May of 2024. Hope y'all enjoyed this content. Please like, comment, and subscribe. And we'll see y'all later. Peace.